standing by. Rick Santelli, that is, at the CME. You're excited, Rick?
Yeah, excited isn't the word. The market should be excited, too. Here's our late but coming out September read on the Consumer Price Index. Headline number up 0.3, 1/10 cooler than both rearview mirror and what we were expecting. And if we look at the stripping out of food and energy known as core, it comes in also a bit less than expected, up 0.2. We were expecting up 0.3. Our last look was up 0.3. Here's the Moneyball numbers. Year over year, 3%. And even though it's less than the 3.1 we were expecting, it's hotter than 2.9. And after all, it's got a 3 handle. And if we look at CPI year over year ex food and energy, it also comes in at 3%. We were also expecting 3.1, but last look was 3.1, so it cooled a bit. So we're seeing interest rates move down and stocks move up. You may be asking why. An easy answer, because it's less than expectations. Is it less than the Fed's target of 2%? No. Which, in my opinion, that fact will rise above all the issues of the day at some point. But yes, we do see rates moving a bit lower. Ultimately, this is a very important number because the market, without any data points, has been pretty much viewed on the notion that the labor market is slowing, and that really is a good thing if you're looking for the Fed cycle to continue its rate cuts. Now, how does this figure in? I can't speak for Fed officials, but if you really have an agnostic view and you look at these numbers, the last thing you think about is we're closing in on the Fed's target. Joe and the gang, back to you.
In a nutshell, that's exactly what people said leading up to this, Rick. It's going to be higher inflation, but it's not going to be high enough to cause the Fed to change any of its plans. And that's what. And we saw something even better. Even if it was 3-1, I think that would have been the case. But even a 10th, I mean, these aren't huge moves, but definitely saw an uptick in the markets, in the equity markets, Rick.
Absolutely. And Joe, you know, when I look at stocks, most of the guests, don't they say, wow, it's getting a little frothy, it's getting a little frosty? My theory is, my epiphany is that the only honest metric we're getting about the U.S. economy now, in my opinion, is the stock market. Because I think all the professionals, I think they look at many things through the prism that's affected politically. And I think a lot of the weakness that we see showing up comes from surveys. And now I have a huge mistrust of surveys. You know what I trust? Credit card activity, and it's going pretty well. Wall Street Journal talks today about it's up over 7.5% year over year. It's outpacing inflation. And guess what, Joe, when you go to a restaurant, Becky, when you go to a restaurant, you get your bill, doesn't it say you get a discount if you pay cash? My restaurant sources say that a lot of people are doing that. There's another group that's spending that doesn't even probably get counted.
Well, and the big issue, too, tips, whether they're in cash or electronic, because with the new tax legislation, if you get tipped electronically, it counts up differently than if you're tipped by cash.
Right.
That's
Exactly.
interesting.
Rick, the stock market has been telling us what to believe ever since Liberation Day. The stock market said this is not going to be the end of the world. Like so many, like almost unanimously, business reporters that tariffs were the end of the world. And here we are, you know, up, what are we up, 36% since then? Right. All right.
Yeah.